off talking about the S&P 500. I have referenced it over the past few weeks that it was going to be in a rolling correction for a period of time. And I put out a tweet this week just prior to the high that was made in the S&P. It was actually put out a day before the market spiked in the overnight session in the S&P 500 futures. And I indicated on the tweet in Naked Swan Trader, that's the identifier on Twitter for the tweets that we put out in real time when we find something interesting. And I identified that the market was likely to reverse in a critical risk window in around the 1418 to 1421 area, and the market reversed right around the 1419 area. Okay, and I'm going to show you exactly what I was looking at to identify that window and how the market has played out following that specific action plan. So what I do in terms of trying to identify when reversals in the market are going to take place, I always try to go back to the most recent dominant breakout point that relates to the action that I'm trying to anticipate. And the breakout point that actually took place that yielded that high prior to the sell-off this week was a breakout above the 1397.82 area in the S&P 500 futures. And in reality, the futures only trade in 25-cent increments. So the reality is a break above the 1399.50 area would have actually been the breakout point. And what I'm basically looking for is a breakout above two boundaries that happen to be in confluence. And without going into the details, I'm sure you're much more interested in knowing what the actionable trading plan is as opposed to the intricacies of the trading model at this point, but I have to pay attention to those details. So basically the two boundary conditions that I'm trying to follow is the yellow line and the teal line. So in the future, you can see here, there's the yellow line, there's the teal line, okay? And I'm looking at the upper boundaries. I'm not looking at the middle boundary or the lower boundary, only focusing on the upper boundaries to determine turning points. So the yellow and the teal boundary happen to be the relevant time frame. The market broke out of that 1399.50 area and rallied. And when did it actually break out? Just to give you a reference, it actually broke out on the 26th of March. Then the market started rallying up, okay? And what I noticed in the market that gave me insight that there was going to be a turnaround is what I'm looking for is a situation where the longer-term boundary of the pair of boundaries that I'm looking at, and as I said, I was looking at the teal and the yellow boundary. The yellow boundary is a longer-term boundary than the teal. So what I'm looking for is the yellow boundary to basically curl underneath the next higher-term boundary. The next higher-term boundary happens to be this blue boundary. So it curled underneath there and then started rising up in the future. So the critical risk window is identified by the area where the yellow boundary rises up inside the next higher boundary. This would be the critical risk window. It was known basically over 140 bars before the event actually took place. And each one of these bars represent a 3-minute bar. So basically 140 times 3 minutes prior to this window, we knew about it. So basically, all the way back, in the early evening of basically the 26th, we were aware of an event that was going to take place in the overnight hours of the 27th. Okay, the early morning hours of the 27th, and I put out a tweet indicating that there would be a reversal in that 1418 to 21 area. And how did I get those points? Well, it's defined by the risk window. If the risk window happens to be identified by the yellow boundary and the blue boundary, that risk window happened to be in the area of the 1421 area to that 1418 area where we have that intersection of the yellow boundary that starts to actually slope up. And once once you're in that window, you're bounded by the upper boundary. So you can see here the market tried to, I'm going to zoom in over here so you can see it a little bit more clearly. And you can see the market spiked right into that area, that 1419 area, and made a high, made an initial high at around 4:18 in the morning on March the 27th. Okay, so that was a perfect area to be selling. Okay, now obviously what we were not aware of in the prior day when we issued the tweet is exactly where in this window price would actually hit the blue boundary. Okay, because it could have hit the blue boundary here, right? Or it could have hit the blue boundary here. But the key thing is we were aware of the lower end of the boundary being 1418, and we were aware of the upper end of the boundary being 21. So really selling anywhere in that window was a good reward to risk trade. Why do I say it was a good reward to risk trade? Because the potential action on the downside is at least back down to the bottom of the blue boundary. And we got down to the bottom of the blue boundary at around 10, 11 o'clock in the morning. Okay, that's for the minimum downside action. Okay, and we got down there around 10:30 in the morning on the 27th. Okay, but the key thing is what tells us how long this trend is going to last once the market downside action starts taking place. So if I zoom in over here, we applied the same kind of action that we applied to determine when the up trade would end. That gave us the sell signal. So here it's the same thing. We're looking for a breakdown below the lower boundaries now, because we're now trying to get a sell signal, trying to determine when to buy the market as opposed to selling the market. So we're looking for the confluence of two boundaries that are tightly packed together. And you can see the two dominant boundaries that were tightly packed together was the teal boundary and the yellow boundary. It didn't have to be the same boundaries that took us up. It could have easily been, a smaller term boundary or a longer term boundary. It just happened to be that the teal and the yellow boundary that took us up, that gave us a sell signal, is going to be the same boundary condition that's going to give us an indication when it's time to exit this mini correction for this time scale. And basically, I'm going to apply the same logic. What I'm looking for is for an event where the yellow boundary curls underneath the blue boundary, the next higher term one. And you could see over here, the market continued staying down. It never got above the blue boundary, so there's our trailing stop. And basically, the market continued to sink into the close, and then we finally have our condition where the yellow boundary is curled underneath the blue boundary. You can see it's starting to curl underneath the blue boundary. Now the key thing is, to end the trade, we need to get a breakout above the blue boundary. We never did, so the blue boundary kept us in the trade, and the market continued to come down. Okay, and basically it came down pretty nice and hard, going into 2 o'clock in the afternoon on the 28th yesterday, and then finally got outside, of the blue boundary, and now you're basically bounded by the bottom part of the blue boundary, which happens to be at a price level of 1390.50. And you could see the market kind of came back down, okay, to the blue boundary, tested it, okay, and basically when it got underneath the blue boundary, it basically broke support. The market actually came a little bit lower, but then again, as I said, it's now back above the blue boundary. The blue boundary is sloped down, which is bullish, and basically the trade is done. Okay, so that little piece, the sell-off from the 1418 to 1420 area, completed itself, in the zone between 1390 and 1395. And this kind of corroborates with some of the action that we were talking about prior, that the market was bounded. I mean, a few weeks back it was bounded in the 1408 to 1413 area, generally with pullbacks into the longer-term pullbacks into the 1380 to 1377 area. Okay, But the piece that I just showed you right now just happens to be a short-term trade that a day trader could take advantage of on a 3-minute chart. Let's try to look at the broader picture of the S&P 500 and see what it actually has to say about the more intermediate future, okay, and how that ties in with the tweet that was put out earlier today regarding a downside trade potential in Apple Computer as we push through the April period, okay? And right now I'm going to be zooming out into a longer term time frame. We're going to go from each bar being 3 minutes to each bar being 89 minutes, okay? And we're going to do the same thing. I'm going to go back to the last time the market broke out of a situation, and I'm going to try to find the biggest boundaries that it broke out of that were zonal. You can see it was the blue boundary and the black boundary, okay, the navy boundary and the black boundary. Okay, so what I'm looking for now is a situation where the navy boundary or the black boundary curls underneath these boundaries. So for this trade to end, for this market to really head south in a big way, we're going to need basically this black boundary to get underneath the red boundary, okay? And when it gets underneath the red boundary, the top of the red boundary is going to be bounding price action, okay, which is like the 1416 area, and then high frequency stuff 1424 area. So that's your resistance, okay? And that and at that point, that would be, you know, towards you know, as you progress further into April. And basically, if we get that signal, you're going to come back down to the bottom, at least the bottom of the red boundary, which is the 1314 area. And if it's anything like what happened on the 3-minute chart with the blue boundary, we got underneath the blue boundary, and it wasn't until the blue boundary started sloping down, and in this case it would be the red boundary would have to slope down, and that would happen somewhere much further in May or in June, because right now I'm getting a lot of equities that have the potential to actually have a mid-month up period, excuse me, not a mid-month up period, but I mean a mid-year up period starting somewhere in June. And some of the stocks that I'm eyeing right now for that happen to be Oracle and EMC, which tend to be leaders in the tech area that I do believe could do exceptionally well, okay, as well as Microsoft on the next upswing. But the key thing is we first need to go through this short-term correction that is likely to play out and build in April and May period. And somewhere in June, we're going to, you know, see what buy signals there are in the tech space, specifically some of those equities that I identified, and also that correction, which is basically outlined for Apple, should you know, likely go, you know, end its corrective phase and begin, you know, at least a short-term trading opportunity on the upside in that period. But the point is, the key thing to take home is that when a correction takes place in the market, you don't want to assume that it can't last longer than just that period. So the key thing is you always want to monitor the trailing stops once we actually trigger the signals, and then make sure that we actually have a buy signal. So as we approach, you know, the end of May, early June, we are definitely going to, you know, put out some webinars and some instructional videos that will actually demonstrate which equities and sectors will look best, you know, in the event that we actually go into another buy signal mid-year into the fall, and in some areas not rolling over until mid-December. And I still am seeing some very, very dangerous action that could put us back into free fall as we progress through 2013 and 2014. So the longer-term perspective has not changed. It's just that we're trying to take advantage of short-term action for day traders and intermediate-term action going out the next few months for the intermediate-term trader. So right now on the S&P, what I see for the next week is that basically we're going to be bounded. There's going to be extreme resistance in that 1419 area to 1424 area. And you can see here that we have a few boundaries that are sloped down, going into the 3rd of April, okay, which happens to, and then everything starts kind of bending up after around April the 5th. So there'll tend to be a real fight put up by bulls in that 1373 area to 1380 area on the downside. So any short-term action there that traders try to sell off, that traders try to short or get out of the market on any rallies into this blue boundary. And you can see the blue boundary starts off at the 1402 area, and then by the 5th rises as high as 1421. So again, there's likely to be a number of tweets that will be put out on Naked Swan Trader on Twitter that will basically identify opportunities short-term to short the market in the S&P 500. But in general, this is the contour for selling, and this is basically the contour, not for buying, but the contour for taking profit if you're not following the trailing stops, because these are real-time things and they change overnight. So, unless you're literally monitoring those things overnight, which we don't have a service that provides real-time monitoring of those things at this point. That may become a service in the future, but the key point is to try to take advantage of the more intermediate term areas of support and resistance, okay? And the key thing is, once we enter that critical window, which was identified for Apple Computer, and that was identified for Apple Computer going into somewhere between March 30th and April 7th. And the critical risk window basically means that that's the period where a market can roll over. It rolls over in one of two ways. It rolls over either by breaking down, and what I mean by that is that once all these boundaries start curling up over here, and let's say the market now breaks down below the 1380 area, then you're going to have a nice wide gap into a downward sloping boundary going into that 1330 area, okay? Now, that's one way that it could trigger in a risk window, is that you break down within that risk window that's identified. Now, the risk window identified does not represent the duration of the trade. The duration of the trade is identified based on, how long it takes to get on the other side of the trailing stop. And that's known before a trade. For this trade, once it does break down, I see it, accelerating and playing out a corrective phase in the overall market, going into the end of May, early June, okay? And a lot of sectors tend to have some action in April, and most of them in May. So that's the real key area to look for. Certainly a very dangerous time to be long the market, and but definitely opportunities will present themselves in June once we see where the relative strength has played out in the equity and futures markets. The other key thing in order to identify what the trigger is for entering in a critical risk window is not just to determine if you're actually breaking down below critical support, but is also if you get a rally into a critical risk window to the upper end of that window, then that is an opportunity to also create a sell trigger event. Those are my favorite trigger events because you're selling into strength, and it obviously means that you're selling at a much higher price when things are overvalued, and when everybody wants something, you're selling it. So it provides more liquidity for short sellers, or just for people trying to exit a large position that happen to only be long-only traders. The other thing that I like about being able to sell into the upper end of a risk window is that if you're employing option strategies, it provides a means of maximizing your collection of option premium if you happen to be selling short, calls, whether it's part of a complex option strategy or whether it's part of a covered call strategy for a long-term investor, okay? Now quickly, I just want to go to Apple for a second. I'm not going to go into too much detail, but I just want to just show you where that critical risk window is. And basically, the last time Apple broke out was where the teal boundary and yellow boundary were consolidated. The market broke out, and then we had the situation where the teal boundary was sloped up inside the yellow boundary, and when price gets underneath here, which is around 610 in that critical risk window, either selling it below here or preferably if there's a spike in Apple up to the upper end, which is 628 to 634 to 638, then that would be a perfect time to sell covered calls against a long position in Apple. Another strategy that traders may like, and this is just educational for educational purposes, I'm not suggesting this trade, is rather than just buy puts, which erode over time if a downward movement does not take place within a certain window of time. One way that is interesting is to actually buy a straddle at the breakout point. So if the breakout point happens to be 610, you're basically buying a call and buying a put at 610 strike price. And basically what you do is you basically sell, and on top of that you also sell a call at the upper end of the risk window at, say, the 630 calls, and then you also sell a put at the first area where there could be support. And you can see this purple boundary, I'm going to zoom in over here, happens to be sloped down, okay, right in the 588 to 580 area. So basically selling a put at 580, okay, and basically with the expiration date being basically a quarter of the length of the period that the straddle is purchased for. So let's say we're anticipating this move in Apple to take place over a 2-month period, and somebody buys basically the 610 put for, let's say, the May or June put, and then buys the 610 call, okay, to complete the straddle, and then basically sells, and the idea is to sell premium at the 630 area, but instead of going out to May, you may get one that basically expires every 2 weeks. So this way you're collecting premium every 2 weeks to pay for the straddle that is taking place over that 2-month period. And that provides a cushion that in the event that the market does not have a high volatility move down to the downside objectives, and the downside potential in terms of Apple could be as low as, the 535 area. That's one area. The other area is 581, and the other area is 587. So this way, that even if the market only goes down to the first target, you would have collected premium to pay for the move to pay for the straddle, which allows for, which is a great trade, because a good trade is a trade that allows you to win or limit your risk under a number of scenarios. And in the future, there will be some training sessions provided that will give you more insight into how I see option strategies playing a role inside critical risk windows, so that traders could go beyond the speculative strategies of just going long or short puts. Okay, and also it could just help long-only traders know when to actually sell some covered calls for some premium. Okay, so that happens to be the outlook there. The last thing that I'd just like to focus on, and we are getting pushing into our 35-minute time period here, is basically the U.S. dollar, Canadian dollar. Okay, and actually I'm going to go to a daily chart of the U.S. Canadian dollar. I'm going to just briefly talk about it, and basically we've been in an up move over here, and you could see, as I talked about last week, the market has basically, this is actually a very noisy chart, so I'm going to pay too much attention to a lot of the noise in the middle. Just pay attention to the area that there's long-term, there's plenty of support over here at the 94 cent area. There's plenty of intermediate term support at the 98 area, and then there's some resistance up at the 102 to 104 area. So that happens to be the trading range for people that happen to be living in Canada and the United States. And the last thing I like to focus on is the spread trade on silver and gold, which we've talked about over the past few webinars. And today was an example where silver outshined gold by a significant margin. It was up about 1.27%. Gold was only up about 1/4% today. And you could see over here that silver basically has lots of support in the 29.78 area starting off, and then of course longer term support in the 26.27 area, and some wide price gaps down the line that could take you, the upper end taking you up to 45. If you go to gold, you could see that it didn't rise as much. The spread is starting to actually, may just be starting to take effect, but again, the spread I was talking about is over a number of months that I'm expecting that to play out. And you can see gold today it's only a movement of about 0.16%, and basically it had a down day, and there's very little distance before there's a lot of resistance in gold. And in terms of downside potential, everything happens to be, the intermediate term happens to be sloped up. So there's a lot of risk in gold. That's why I still like the idea of being long silver and short gold for the intermediate to long term. There's another reason fundamentally why silver down the line may outperform gold, and there's been some talk, like in Bolivia and in some of the silver mines. There is a potential that there could be some nationalization of some of the mines around the world in silver, and in that event that could definitely provide a catalyst for silver to move up to some of those upside targets that I was speaking of over the next few years. And those targets are in the 80 to north of $90 area, and well into the even above 120. I can see actually taking place, as the markets go into turmoil, in the next few years, that, kicking off, later this year, early next year, for pretty much every sector. Okay, so that is basically the market outlook for this week, and now I'd like to turn it over for any questions the audience may have.
Thank you, Efrem. Any questions real quick? We have one question. Efrem, it looked like on the S&P you were setting up a resistance range there of about from 1420 to 1380. So if people were tracking the S&P 500, they would be looking for resistance coming in at that upper end, 1420, and then support at 1380. Is that what I'm looking at? And if so, what time frame are you looking at for that event, for those that to play out again? Just to review that time frame.
Sure. Okay. So basically, on the S&P, this teal boundary happens to be that resistance area as we go into the critical risk window for Apple. And I really want to focus on the very near term here, because really Apple Computer has been one of the few things that have been holding up the market. And by getting insight to when Apple is about to crack for a correction could really give some downside movement to the S&P 500. Also, oil has rolled over this week, and some of those companies in the S&P 500 and the Dow, like ExxonMobil, have big market capitalization in the index, and having oil being in a correcting phase, and likely being in a correcting phase as we play out, through the May period, before we have another chance of an up leg in technology in June. Basically, those, between oil and Apple, those are the two things we probably want to pay attention to, but that's why right now that window, the critical risk window for Apple, to commence a move down and trigger either by rallying up to the upper level or by breaking down, basically that window goes into around the 7th. It starts there and then goes out for many weeks. So that's why by following this upper navy boundary, which kind of inflects into the 9th, it kind of covers that risk window for some of the critical markets that we're looking at to roll over on any spikes or breakdowns. And basically, you could see here for the S&P 500, the upside is actually 1424.26. Even if you look at the high-frequency components, prior to the sell-off, they only went as high as about 1426. And even if I go into the future and look at the highest thing, components that I could see, they really only go up to about 1425. So I would say, comfortably, there should be a lot of, sell signals triggered on shorter-term time frames, on any spikes into the 1424 area, and it starts out, literally in the 1404, but around that critical risk window which is between that, basically the 3rd and the 7th. The 3rd, basically, it starts out at around 1416, and then basically going into the 7th goes into around 1424. So those are the levels on the upside. The levels on the downside for the very near term is this teal boundary. Any boundaries that are sloped down will tend to act as support. It doesn't mean it's a buy signal. It just means that if I get a sell signal, I want to be taking profit in any longer-term boundaries that are sloped down. And so basically, this boundary happens to be sloped down at the 1380 area. So that, yes. So 1380 to 1324 happens to be the boundary going into the window. Once you break below that 1380 area, anywhere in that window or even into, the 10th of April, and you're in there and you start breaking down, you could see here already we're getting a clustering. Do you notice we're getting a clustering of this green boundary with the yellow boundary? So basically, anywhere in that risk window going into April, going even into the middle of April, if we break below, let's say on a closing basis, on an 89-minute bar basis, let's say we trade underneath 1378.75 on the June E-mini S&P 500 futures, and you trade below that level for more than 89 minutes, so let's say for an hour and a half, then basically we've got an intermediate term sell signal in play, which will not end until this yellow boundary curls underneath this blue boundary while both boundaries are sloped down. Both are sloped up. So the only way to get a curl of both boundaries is to get a major breakdown in the market, at least down to the 1330 area, and then that would be an area to take profit. And then basically at that point, until we actually could get outside of 1370, we're in a corrective down phase that I believe will accelerate through May and provide a buying opportunity in technology mid-year.
Okay, very helpful, Efrem, and that's appreciated. So it looks like what I hear you say is that Apple Computer is a key stock to watch, and we have a briefing that's been produced on Apple Computer. That link to that video briefing, which is about a 6-minute summary overview of the critical points on that, I would encourage you to take a look at as well. Anything else, Efrem, before we wrap it up today?
I think that pretty much outlines what I wanted to talk about. However, I think maybe we should just focus on just one more chart over here. And what I'm going to do is I'm going to put up the Dow transports, because I think it really shows a lot of weakness that we've been talking about. So I'm just going to put that on really quickly here. And that is going to basically try to show you just how bad things really are, even while we're able to find these potential trading opportunities in the short term. So here's the transportation index. Yes, there's a lot of lines on the screen, but let me make some sense out of this. Basically, we're in an area, you can see over here, a rather dangerous area. Just recapping, is that the Dow Transport, as I said, looks very different. It's a very different structure than the S&P, and the reason is because it's got a risk window that extends, that basically is a black cloud over the overall markets all year. So, even while technology is, can outperform again mid-year, or even while technology has outperformed, in the past few months, the transportation index, since we've been talking about it, has really not been able to get outside of any one of these boundaries that are sloped up. And you can see that we're just about getting on the other side of this teal boundary, okay? And that's going to provide really no support in this market as we, pass through the April and May period. In terms of resistance, unfortunately, for long-only traders in this in the transportation index or stocks tied to it, you could see here that most of the longest-term boundaries curl over in around late May, and basically you have a situation where you're bounded by this black boundary and this teal boundary right through June. So you're not going to be able to get outside of this boundary, and if you can't get outside of this boundary till June, you're not going to be, by the time this thing inflects, you're already into another boundary that's basically going to be keeping the market, below that 5,600 area, okay? Which doesn't, which the upside potential from, basically the highest high that we had in the index, which was around 5,400. It's very, very small upside potential considering the downside risks. And the downside risks, as the overall markets get into some dangerous territory, as we discussed later in the year, early next year, basically everything is sloped up below us. There's no potential for support. Everything is curled up above us. And basically, the risks are basically over 50 to 60% downside for a very small potential on the upside. You can just see the distance between here and here compared to the distance between here and here. A very, very bad trade. So I wanted to bring up this chart just one more time just to show that don't think the economy is out of the woods. There has never been a time in history when the transportation index has given warning signs like this and something terrible hasn't happened to the overall economy in the more intermediate to long term. So any market action that provides a buying opportunity mid-year is just a trading opportunity. And yes, it's true that because we're in a revolution in technology, especially in networking and in wireless networking and the cloud computing and storage technologies, yes, companies like Oracle, companies like EMC, and IBM and Apple, have a future. But that doesn't mean that a lot of companies, that aren't as innovative as those technology companies aren't going to be suffering a tremendous risk later, starting sometime later in the year, early next year, and lasting for a period of time. And obviously at that point, whatever buying opportunities we have in technology going from mid-year into the end of the year, we're going to have to look to pair off those positions, going into the fall or December period, so that we could then take advantage of another buying opportunity in the strongest sectors that I believe will be with us for the next several years. And I do believe that will be technology, but you got to pick it at the right points, and that's why it's so important to evaluate those risk windows and not be exposed during those windows, and then wait for those trades to play out and get on the other side of the trailing stop before we actually try to actively seek out buying opportunities. And I do believe the next opportunity for that would be the early part of June, and we'll revisit that. And if indeed we haven't got on the other side of the trailing stop and it's the beginning of June, then we don't have to go long the strongest areas that held up during the downswing. We just wait for current market action to tell us when it's time to get involved. And when it is, you want to go long the strong areas, and you want to stay out of the weak areas. And from a spread trading opportunity, there may even be areas like transportation that indicate very little upside at that time, and at that point you may want to short transportation and go long technology. And that provides a trade that allows you to, to generate potential profits, but also minimize the downside risks while technology moves up in a variable way. So that's pretty much ends what I wanted to say this week.
Thanks, Efrem, and thanks everyone for being with us today. Again, we'll bring the home page up for a slide to see here at the end, and we'll go right here. Just one second. Should be able to see that. And I'd like to highlight the free market briefings that you can be in the loop if you simply sign in your name here, put your email address here, hit the submit, and you will automatically receive a link and notice for next week's critical market briefing. Thanks for being with us, and we wish you all a great day.
The organizer has ended the session, and this call will be disconnected. Goodbye.